This is the High Voltage Business Builders Podcast, daily intelligence for serious e-commerce portfolio builders across Amazon, TikTok Shop, Shopify, Walmart, and every channel that moves the needle. Neil Twa and his team, all day, every day since 2012. Let's get into it.
On May 2nd, a structural change quietly took effect that will reshape how every Amazon and e-commerce seller sources products from China. The de minimis exemption for Chinese imports officially ended. If you're a seller currently bringing in goods from China, this isn't just a regulatory tweak, it's a fundamental shift in your cost structure. For a beginner seller launching their first product, this means your initial landed cost projections just got more expensive, potentially eating into your already tight launch budget. For a growing brand doing $50,000 a month, those new duties could translate to thousands of dollars in unexpected costs, eroding your profit margins, impacting your ability to reinvest in inventory or marketing. And for advanced operators managing multi-million-dollar supply chains, this change demands an immediate audit of every single SKU, because what was once duty-free is now subject to full assessment, potentially shifting your entire product portfolio's profitability. This isn't theoretical, it's real money hitting your bank account now. Are you prepared to absorb these costs, or will you adapt your sourcing strategy to maintain your competitive edge?
The core strategic insight here is simple. Every SKU you source from China now faces a full duty assessment. What does this mean for a seller doing $5,000 to $50,000 a month? Let's say you're importing a product that costs you $5 per unit, and you're bringing in 1,000 units a month. If that product category now carries a 10% duty, your landed cost just jumped by 50 cents per unit, or $500 per month. That might not sound like a fortune, but if you're operating on a 20% net margin, that's a 5% hit to your profit. If you spend $2,000 a month on ads, that $500 could have been an extra 25% of your ad budget, driving more sales. For larger operators scaling toward $100,000 or even $1 million a month, this impact multiplies. Imagine importing 10,000 units of a product with a 25% duty. That's an additional $12,500 in costs. The underlying mechanics are straightforward. The government is closing a loophole that allowed low-value shipments to bypass duties. This means your sourcing stack, your supplier relationships, and your product selection criteria all need immediate reevaluation.
Let's look at how this plays out. Take Sarah, a seller doing $30,000 a month with a popular line of home decor items. Her main product, a ceramic planter, was previously imported duty-free under de minimis. With the change, her HTS code now carries an 8% duty. On her typical order of 2,000 units at $7 each, that's an extra $1,120 per shipment. Initially, she absorbed it, watching her net margin dip from 22% to 18%, but she quickly realized this wasn't sustainable. Sarah started negotiating harder with her existing supplier, offering larger order commitments for a price reduction, and simultaneously began exploring alternative sourcing from Vietnam and Mexico for future product lines. Her outcome, she managed to offset half the duty increase through supplier negotiation and is now diversifying her supply chain, making her business more resilient. Contrast this with Mark, an advanced operator running a $500,000 a month brand specializing in electronics accessories. He saw this coming. Before May 2nd, Mark had already identified his highest exposure SKUs and initiated conversations with his freight forwarders and customs brokers to understand the exact duty rates. He then strategically adjusted his pricing on certain products by 3 to 5% to cover the anticipated costs, communicating transparently with his wholesale partners. For new product development, his team now prioritizes sourcing from countries with favorable trade agreements, shifting his R&D budget accordingly. The outcome, minimal disruption to his bottom line, and a strengthened, more diversified supply chain. This is what sellers who survive platform changes do differently.
To navigate this shift, here are 3 concrete executable moves for sellers at any level. First, audit your existing product catalog immediately. For a beginner, this means reviewing the HTS codes for your current and planned products, understanding their duty rates, and updating your cost of goods sold calculations. For an advanced operator, this involves a comprehensive spreadsheet analysis of every SKU sourced from China, calculating the exact duty impact on your profit and loss statement. This isn't optional, it's foundational. Second, renegotiate with your current suppliers. A small seller might approach their supplier with data on the new duty costs, asking for a slight price reduction or more favorable payment terms to help absorb the shock. A large operator with significant purchasing power can leverage their volume to demand more substantial concessions or explore long-term contracts that mitigate future price volatility. Don't assume your current deal is the best deal. Finally, diversify your sourcing strategy. For a growing seller, this might mean researching manufacturers in countries like Vietnam, India, or Mexico for your next product launch, even if it's just for 1 or 2 SKUs to start. For a high-level operator, this translates into a strategic initiative to shift a percentage of production away from China over the next 12 to 24 months, building redundancy and resilience into your entire supply chain. These proactive steps ensure your business isn't solely exposed to single-country regulatory risks.
The end-of-day Minimis for China imports is a significant hurdle, but it's also an opportunity for those who act decisively. This isn't about fear, it's about informed action. Whether you're just starting your Amazon journey, scaling past $10,000 a month, or building a multi-million-dollar brand, understanding and adapting to these structural shifts is critical for your long-term success. At Voltage, we've been navigating the complexities of e-commerce for 13 years, helping operators like you not just survive, but thrive through every market change. This isn't a course, it's the room you've been looking for, a community of high-level operators who have generated over $100 million in Amazon brand revenue and built businesses designed from day one to exit at 2 to 10x multiples. If you're ready to stop guessing and start building with proven strategies, we invite you to book a no-pressure discovery call to see if you qualify to work with Voltage. We have limited partnership spots available for operators committed to scaling their brands. Visit voltagedm.com today. Don't just react to the market, lead it. This has been the High Voltage Business Builders Podcast.
That's a wrap on today's episode. If something we covered today sparked an idea or made you wonder where you actually fit in the e-commerce landscape, there's a good place to start. Head over to voltagedm.com/discover. Answer a few questions, and we'll point you toward the right path for where you are right now. We'll be back tomorrow with another edge. Until then, stay high voltage.